All right, so good morning, everyone. A very warm welcome to our today's webinar as part of our series of webinar deep dives with IIQF experts. Today's webinar topic is on machine learning career opportunities in quantitative trading, investment strategy, and risk hedging. And to present us on this topic, we would have Sanjay Bhatia. So just like to briefly introduce Sanjay to you all. Sanjay has done his MBA Finance and MSc in Machine Learning and Artificial Intelligence from Liverpool John Moores University and has a postgraduate diploma in Machine Learning and AI from IIIT Bangalore. He is currently working as a director with UBS Risk Modeling and Analytics, Model Risk Management and Control in the Chief Risk Office function. And Sanjay has a risk management, or rather Sanjay is a risk management and analytics professional with 15 plus years of mainstay experience in risk models and methodology, space encompassing Basel, Advanced AIRB, IFRS 9, IMM, SSECR, Exposure, XVA, FRTB, OTC derivative pricing, and other advanced modeling topics. Sanjay has previously worked with various foreign banks like Barclays, RBS, Citi, Credit Suisse in risk consulting. He's very passionate about imparting practical model understanding and insights and has been a professional trainer for corporate and investment banks. His area of interest are credit and counterparty credit risk, market risk, stress testing, stochastic modeling, quantitative finance, and machine learning. Right. So before I hand over the session to Sanjay, just like a brief lay down how we would proceed with the session. So the session will be total of about 1.5 hours, and in the first 1 hour, Sanjay will briefly talk about the topic of today, and then we will have a mock interview session for a position in this machine learning profile in a quant trading desk, right? And then after that, we would go into the Q&A. And briefly, in the meantime, we would give a short intro about ourselves as well, right? So that's the general flow. And since the audience size is quite large, so we would request you to understand that we would not be able to give you speaking right, but nonetheless, we want the session to be as interactive as possible. So please, type in your any question queries in the chat window, and we would be happy to take up. Right. So with that, I will hand over the session to Sanjay. Sanjay, whenever you are ready, you can start the session. Just a minute, I'll make you the presenter as well.
So very warm welcome to everyone, and let's get started. Is my voice clear? Let me
Yeah,
just
absolutely. Absolutely.
So I'm sharing my deck. If you are able to see that.
Yes.
Okay, so let's get started. Again, a warm welcome to everyone who have joined and who have been following these series of session where we are creating broader awareness about machine learning in the context of its application to quantitative finance, computational finance, financial engineering, risk management, portfolio optimization and management, and algorithmic trading. So in this series, we have covered quite a lot in terms of creating awareness about the adoption and application of machine learning to these various specialized subfields of finance. But today we are at a juncture where we would be diving deep into the application of machine learning for quantitative trading, or what we sometimes refer to as algorithmic trading as well, right? So we would, as Nitish has touched upon, we would just provide the context prior to moving into specific idea where we want to showcase the demonstration of the skills. And by the demonstration of the skills, I mean that how somebody who would be uh, honing these machine learning skills could basically enter into quantitative trading and algorithmic trading, and how that interview or evaluation process will pan out. So that would be one of the unique feature of this series, that we want to provide people with clear career pathing and career trajectory, how they should see them being evaluated by the broader industry, what kind of questions would be asked, what kind of grilling would be done, what kind of evaluation will be enforced onto such interview session where somebody would hire for quantitative trading and algorithmic trading rules, right? So with that, we have an action pack for the day, and let's get started. Maybe broadly setting the context very clear. So algorithmic trading and quantitative trading is, as most of you would already know, is a programmed version of the manual trading, where a trader is being replaced by some algorithm, some program who does the trading, who take the positions in the market, who decides which direction to take the position, what would be the size of the position, how to design a trading strategy given different market conditions, how to uh, uh, exploit any arbitrage opportunities. So it is a set of, we can read it simplified reality of the world. We can read it as a set of pre-programmed trading instructions, right, which are a rule set which is created given the different market data set, the different market conditions, the different economic settings, uh, the the different firm strategies, so that the algorithm itself, given a situation, given a scenario, would be able to take the position in the market, right? But the advantage of doing algorithmic trading and quantitative trading is in fact very clear, that it enhances the speed of the execution is the key here, right? A trader, when it comes to different areas of high frequency trading or complex strategies, would not be able to recalibrate its strategy on the real time. However, an algorithm, once trained on a particular rule set, would be able to quickly adapt, recalibrate, deploy uh, in the real time various complex strategies, which would then allow somebody, a trading firm or a trading desk, to exploit not only uh, you know uh, anomalies in the market, but various arbitrage opportunities in the market, various different mispricing across the markets. So it is in the spirit of going global with the trading, and doing trading in a very fast way. The execution is the key, the speed of execution is the key, right? And that is enhancing the returns of the firm. And obviously gone are the decades or the era when most of these prop trading firms or proprietary trading firms or even asset managers used to generate easy returns. Now in the era where the returns are squeezing, right, the only competitive advantage they could create is to execute their strategies faster than others, and also to execute in a way where a lot of real time data could be exploited in order to dynamically adjust the strategy to the market conditions. And the market conditions have been sort of very volatile and choppy forever, right? Forever. And recently you have seen that the economic cycles and the investment cycles and various different credit cycles have changed. They are reacting faster, they are changing faster, right? So that's why that's sell the business case of adopting algorithmic trading as a win-win, as a short winning strategy for a trading firm, whether it's a broker dealer, whether it's a set manager, whether it's a proprietary trading firm, whether it's a hedge fund, right? So all these firms are very aggressively looking at adopting algorithms for their trading and pre-programmed instruction kind of decision engine for their trading. And today, as said by many quants, quants, maybe analysts, that the today world, the today war of investment within the investment world is not about uh, trader versus trader, or trading strategy versus trading strategy. It's rather algorithm versus algorithm, right? So that speaks volumes about how algorithms have been adopted to do trading. And in fact, the major benefit which has been realized out of doing algorithmic trading is that in many asset classes, in many asset classes, those asset classes where the illiquidity was a concern, the sparseness of trading activity was a concern, right? Because of algorithmic trading, a lot of trading volumes have been generated, a lot of liquidity have been generated. And that's why you see that in today's world there are many alternative asset classes, like your cryptocurrencies, uh, which means bitcoins and all these cryptocurrencies, as well as the renewable energy, green bonds, carbon trading. All of this is happening just because there's some algorithm which is working, and which is trying to do the market making activities, do the pre-trading activities within these markets, which were previously illiquid and were dominated by only few big wall streeters. Right now it's being exploited by a lot of participation from every direction. Most of these asset managers, fund managers, proprietary trading firms, small boutique investment banks, right, treasury desk of many corporates, right, they are exploiting and entering into the fold and trying to that eventually systematically create liquidity in the market. So that's one very key area where not just it is related to how a firm can transform its business model or core competency by following algorithmic trading, but also in general what are the potential benefits of it which are accrued to the market to exploit, right? So going by the stats, you would see that algorithmic trading market, which is very recently through some stats crunching, was tagged at 11.66 billion USD dollar. That is the size of the market, as by which was noted in 2020. It is going to reach 31.49 billion dollar by 2028. So there's no surprise that it is going to grow manyfold, and at least very conservatively threefold, 300 times it is going to grow. And which presents that maybe holistically, if you see that the annual growth rate since the algorithmic trading has came into picture, year on year annual compounded growth rate has been 10.7%, right? And which are the players? As I told, that many of these strategy focused funds like arbitrage funds, the hedge funds, the quant trading firms, the global family offices, or some special investment, special purpose vehicles, proprietary trading firms, high frequency traders, high street brokers and dealers, big boutique investment banks. All of these are all of a sudden competing against each other, trying to get as much share of the market as possible, right? So what does it present? Where's the profitability spot, right? Because you need to understand the business context. Because if you would be working, if you are a mid career professional, you would uh, like to strategize accordingly. You would be asked, evaluated on these strategic questions: why algorithmic trading, how it would enhance our profitability. And hence, let's answer what is the profitability spot. Now there are many profitability spots in this area. There's no doubt that with the ascent of digitization and data revolution in last decade, we most of the firms are sitting on huge mines of data. So the essence lies in doing the data mining. And what to mine, what kind of data to mine? The data mining is not about people generally see that data mining is just about processing huge amount of data. No, it's not just that. it's also about mining and harnessing the potential of alternative data sources which have never been exploited or explored before. One of the alternative data sources which is many time used by investment banks is how they can use the low orbiting satellites to understand what is the revenue forecast of each of the firm which they are analyzing. So how they would understand, maybe they just take pictures, random pictures from some retail stores and the parking lot of retail stores, how many cars are parked in a particular retail store, and they just try to make it what would be the sales forecast of that particular retail store. If you add such kind of data, you know, together through in a fast way, you would be able to ascertain what would be the value, the market value or the market price somebody should pay for a particular stock, right? Wh- whose revenue forecast, you know, would be projected like this. So so various algorithms are or alternative data sets are exploited to understand the revenue forecast. Various sentiment analysis indicators are built in the algorithm, right, to understand, not only to collate all the sentiments in the market. So many times markets are driven by irrational exuberance and uh, the the opinions expressed by various analysts, the opinions expressed by various analysts on different social networking sites or different tweets or different platforms can be collated to build a sentiment indicator to indicate that what is whether the market is, from a sentiment perspective, is it bullish, is it neutral, or is it bearish, right? So a lot of these satellite data which include visual data, image data, maybe sometimes aerial and drone data, social media data, the IoT data, the energy data which is specifically required for green bonds or carbon trading, the supply and demand data, weather data, climate data, carbon footprint data, geolocation data. A lot of this kind of data set was never explored before or exploited before, which has now been exploited with the use of some algorithms, some machine learning algorithms which are specifically deployed on these alternative data set and act as a feeder model to your mainstream algorithmic trading decision engine, right? So there could be machine learning which could be applied at using more data to evaluate or to design the trading strategies, as well as within, once a trading strategy is overall designed, how to optimize that particular trading strategy, how to calibrate it on real time, how to make it very dynamic in this fast changing world where volatility spikes are happening and everything. Maybe we are seeing many things, the entire economic regime or market regime changing very fast way, right? So there are two ways of looking at machine learning application. One is the pre-feeder, as a pre-feeder model, as a pre-feeder or a pre-trade or a pre-trade analysis, or as a feeder model, what it could do to harness the potential of the data, the unexplored data or the alternative data sources. And then when it comes to the main algorithm which is designed again, based on some machine learning techniques to do the trading on a very high frequency way, how to process the data in a fast way, how to recalibrate the model in a fast way, how to deploy trading strategies in a fast way, how to dynamically adjust trading strategies rules, the trading rules in a fast way, to respond to the changing market conditions, right? So that's maybe, so pre-trade analysis, trade signals, and trade execution. That is the key, right? That is the flow. How one should be thinking, not just about one particular aspect of the application of machine learning to this entire value chain, but rather front to back, end-to-end perspective, that machine learning could be deployed or employed to do a pre-trade analysis or trading, designing the trading signals, which means designing the trading strategy, and then doing the trading execution, which means deployment of the strategy, right? And once it is done, right, most of these firms, whether on the firms which are doing some as a agency execution means that those kind of business model where they have the mandate from the client to invest money on behalf of the client, right? So agency execution trades can be performed. Principal trading, which is the trading by an investment bank or by a boutique investment firm or a proprietary trading firm, where they're investing their own capital into the markets rather than investing their client capital into the market, which was the case in agency execution. So principal trading could be done. So principal trading could then be done. The strategies could be devised, whether they want to do the market making activities or they want to do the proprietary trading activities. The market making activities is the very predominant feature of most of the investment banks, which generally find a market, create liquidity in a market, create trading in a market which was not that well traded, so that then they could price it properly and they could then pitch that particular price. They could do front running of that particular or underwriting of that particular subscription in the market. So market trading is, suppose if somebody is coming with a new instrument or a different type of instrument, but there's no market available, there's no trading, or there's very thin trading available. How an investment bank or a boutique investment bank front run the books, do the market making activities, discover the price, right? Then advise the right price at which the most of the trading will happen. One can achieve the huge volumes, one can generate the huge volumes, right? So they do trades in the market, they do buy and sell positions in the market just to generate liquidity, just to generate trading, and to deduce the price, right? So that's the market making activity. But when an investment bank or a boutique investment bank or a proprietary trading firm is directly trading in in a market which is already established, where the trading is already happening and other participants are already trading in that market, that is called proprietary trading. But proprietary trading, as I told, is differentiated from the agency execution or agency trades, because proprietary trading, a firm would be trading with its own capital, it's its own risk, they're deploying its own capital, versus the agency execution where they're deploying the capital on behalf of a mandate given by their clients. So it's their clients capital which they are deploying in the market, right? So that's the area where maybe one should try to see the overall market structure, right? And Yeah. So now, what are the basically various areas where such kind of algorithmic driven trading strategy is looked at, and what are different kind of strategies? So there are different kind of strategies, like you must have heard of arbitrage firms or arbitrage strategies. These different strategies involve statistical arbitrage, volatility based arbitrage, index based arbitrage, automated scalping. So all these but essentially what is happening is, under arbitrage, what a trader wants to exploit is the anomaly between two markets, the pricing anomaly between two markets. So various markets, due to various time zones, the opening bell and the closing bell maybe doesn't overlap to a certain extent, the time, uh, uh, the trading timing overlap, but there's no overlapping trading time as well, that when US markets open and Hong Kong market closes, right, there's a lag. So if a particular stock is traded or listed on both the exchanges, like Alibaba, if it is listed on Hong Kong Stock Exchange as well as the US stock exchanges, then some information which get built in into the price in Hong Kong trading hours or Hong Kong Stock Exchange, when trading is happening, will take some time to flow into the US markets when the opening bell will be rung, right, in the US markets. So, but there's an arbitrage opportunity. The price has already taken some additional bit of information, right, in one market, but it is yet to be reflected in another market. So such kind of arbitrage, right, such kind of typical arbitrage could be exploited by building a trading strategy. And this is a global strategy where uh, nobody is confining to one market or one asset class or one instrument. It's across asset classes, across markets, across instruments. Wherever there's a particular kind of arbitrage, right, the a trading strategy could be designed, right. So the second aspect is the frequency trading. Now you understand that the trading usually happen in various ways, like there's a uh, uh, obviously intraday trading, right, which and but if somebody want to do not only intraday trading, but within an intraday they want to do go ticker by ticker, every nanosecond they want to do deploy huge sums of money and wind and unwind positions by taking bulky positions, but by taking bulky sized positions, then that is called high frequency trading, where not only just you are doing intraday trading, but within intraday trading you are doing ticker by ticker trading, right. So high frequency trading or ultra high frequency trading or market making activities generally happen in a by processing huge amount of trading information in a very fast way, right, so that you could generate a lot of trading volumes and trading liquidity within short snapshots of time, right. So the response time is very less. You got to build up a position, and within few spells you got to take away that position to make a quick buck or quick profit out of it. So that is what we refer to as the frequency driven trading, right. Then there are low latency trading models, where generally we look at more structural elements, right, more structural elements of the market, right, and try to design a trading strategy. Like it could be maybe something like a bid ask spread uh, uh, based trading, or something like a demand supply imbalance based trading, something like even processing. Somebody has a huge large order to process, how they will go about uh, you know uh, assessing the market liquidity when that large order should be placed, when we would have enough supply of that large to fulfill our large order. So that those kind of structural aspects of trading are called low latency trading. Then there are other tradings which you must have understood, like in your uh, while reading the technical charts, you examine the correlation between two instruments or two asset classes, and you start doing the pair trading or correlation or covariance based trading. Then there's a trend based trading, there's a short holding period trading, and there are factor models, right. So all these are aspects are summed up together as different strategies which are designed, devised, and deployed, developed and deployed by prop trading firms, right. And that is the most profit making business of any investment bank. No matter how many times people say that it is risky, but investment bank, if they were to be truly called an investment bank, and if they were to generate the kind of profits which is expected out of an investment bank, would surely do a prop trading, right. Then obviously agency trading is where I'm as I told, that you are deploying money on behalf of there's a principal agent relationship. You are deploying money on behalf of your uh, clients, on behalf of your somebody who has a brokerage account with you, or maybe somebody who has given you mandate, right. So it could be there are different trading strategies which would be volume weighted or total weighted asset average price, or there could be market making activities here as well. There could be some directionality driven maybe positions as well, that you are not betting on the price, but you are betting on the direction of the price, right? There are different maybe. And again here, there's another algorithm which specifically work on trade execution, the last leg of the value chain, the entire front to back trading value chain, the trade execution as well, how you process the orders, right? Whether that can be generated, that can be automated, that can be handled through a pre-programmed set of decision rules. Yes, they can be. Algorithm can execute the orders. It can maybe do the order routing. All these kind of logic, how to process a small to medium to large order, can be programmed into a machine to then maybe uh, execute the orders at faster speed, execute the orders in an optimized way, execute the orders so that to ensure that there's least execution failure in the orders. So all these things can be broadly looked at, and these are some of the aspects which generally maybe I'll show you here, right? So these are some of the aspects which generally you see that constitute part of the quant trading as a subfield, and more so the various algorithms and machine learning applications, the use cases of machine learning form these broader sets within the quantitative trading, right? So the other aspect is that the portfolio management and risk management, which is the second line of defense and third line of defense function, right? The first line of defense would all obviously do the trading activities, would generate the business. The second line of defense and the third line of defense would do the risk management, portfolio management, all these kind of activities that could again be uh, done using some machine learning models. So the machine learning application is not just confined to the first line application, the application to the first line of defense, but also to the second line of defense and third line of defense, where you are doing the risk management activities, which are, by which I mean you are trying to do some hedging activity for the portfolio, for the investment portfolio, or you are trying to do optimize the portfolio, optimize the asset allocation within the portfolio. You want to ensure that your portfolio doesn't have any concentration risk. You want to have a diversified portfolio. Now that is not done at a trading desk to trading desk level. That is not something which generally actively taken care by the first line of defense. But in the second line of defense, the risk managers who control the risk, try to set the limits, try to design the risk appetite framework, try to set the threshold levels, the tolerance levels, try so that maybe to ensure that we would not take a heavy concentrated position in one asset class or in one direction, right? So that is what is risk management, or as also the hedging activity. Like the hedging is now being centralized after maybe the Basel III, the CVA hedging, and different aspect of XVA hedging, the credit valuation adjustment, the margin value adjustment, or the funding value adjustment. All these has been centralized. So the hedging activities are basically centralized, right? So the some of these we could also these also form the part of the use case, broader use case, because not only that we are uh, just talking about the first line of defense application of machine learning, which is any which way broad, right? Which is any which way broad, as we just discussed. But the second line of defense as well as the third line of defense. Now the third line of defense could validate these models, right? The third line of defense could validate these models. So if you are validating a machine learning based algorithmic trading models, you obviously need another model, another benchmark model, which which will again be based on machine learning to validate the first model. So there are different aspects of application within the second line and within the third line of defense of a bank, right? Which could be again done in a machine learning way or in a data driven way, rather than following some statistical models or theory based models or assumption based models. You could use the database way of doing modeling, machine learning modeling, and apply those models not only in first line but also in second line and third line. So that's the point which I'm maybe broadly trying to make out here, right? And you could see that the major uh, unique use case of trading which has been exploited very well in last few years is high frequency trading and market sentiment analysis. Now, the story about market sentiment analysis, as I told, is that uh, in very choppy and volatile markets, right, where the FIIs or hot money or the portfolio financial the PFIs or portfolio investments or for foreign institutional investors are moving money from one market to another, because the no market is stable. Yesterday when people expected US to stabilize, all of a sudden there are concerns of elevated inflation and ever rising in interest rate to normalize the interest rate. Now that is haunting the US markets, and maybe it's becoming more and more volatile, right? Now across the emerging markets, the BRIC, the Brazil, Russia, India, Mexico, China, Indonesia, all of that together, right? Nobody has now, for now, no global fund, major global fund has been fixated on any particular market, because they understand very clearly that these are emerging markets, the risks are also emerging. And it would be a case that today, if Brazil is favorite, tomorrow India is favorite, maybe once we get over Ukraine, might be Russia will become favorite, right? So you have to constantly keep moving money from here to there to here, right? So so the point I'm making is that market is not also driven by pure quantitative measures, but there has always been a lack that we are unable to build the sentiment indicators into the market, whether the market, a particular market is more dominated by bulls or bears, right? Or is it neutral? Or is it neutral, right? So that depends upon, so you need to have, in order for your strategy to be a bit broadly exhaustive, covering every aspect of the market, you need to cover the irrationality or the opinion in the market, the dominating opinions in the market, which would require some kind of sentiment indicators besides the quantitative indicators which are built into the market. Now let's see here, right? These are different kind of indicators which are already part of your algorithmic trading strategy. You have trend based indicators, you have certain momentum based indicators, you have certain volume based indicators, you have volatility based indicators, right? So all these indicators, quantitative indicators, can be bucketed, right? You could have multiple indicators under one or the other. That depends upon what is the how your trading strategy, uh, whether your trading strategy is more uh, driven by the trend. So there are trend based strategy which would place more weightage on the trend indicators, or it is more placing weightage on the momentum based indicators or volume based indicators or volatility based indicators. The only point I'm making is that beyond this, right, beyond this, the it is only machine learning models which can build sentiment based indicators as well. So we would not only confine to these four of them, but we would rather have sentiment based indicators built into our trading strategy, so that we would get to know that what is the thriving sentiment in a particular market. Because sometimes, even if trend is supportive, momentum is taking your price to a particular level, right, volume is providing the base support from behind, volatility is trying to reach the upper bound of that particular price band, right? Everything is supportive, but the sentiment all of a sudden is indicating in a different direction. The sentiment is not supportive of uh, you know the the bullishness in the market. There are many bears or bear stories or bearish news articles which are appearing, which will mm, which will indicate that there would be some correction. So at this market, even if these quantitative indicators would tell me that I need to deploy money uh, in a fast way to see the upside in the market, some sentiment indicators um, would tell me the different story, that wait for the upside, right? Wait for the upside, right? uh, and then there would be definitely a downside, a sharp downside, which where the bears will overpower the bulls, and such opinions are already there in the market, right? And we should then buy it at the correction, right? So it's like, you know so the power of machine learning is to process the big data, and not only just big data by volume or by velocity or by variety, but also big data by such data which could not be harnessed or exploited by traditional models, right? So that's alternative data like sentiment data or satellite data, or maybe tweet data, or how people's are opinion, sharing their opinion on a particular Twitter handle, which is generally referenced by many to do the trading activities, where the people come and express their opinions, right? How the news articles could be processed, right? The from the Wall Street Journal to the main all financial dailies, how could you some if there would be some feeder model which could pluck the negative words or keywords from the news articles and tell that overall a particular news article on a given day is telling me a bearish story or a bullish story or a neutral story, right? Or extreme bullish or extreme bearish. We could granularize it the way we want, to closely track the sentiments in the market. And Now, having covering this context, now let's talk about a application. Now, this application, which is an area of machine learning, which is called reinforcement learning, uh, holds a lot of promise for algorithmic trading or quant trading, right? The first thing is that you need to understand that what is reinforcement learning. Reinforcement learning is an area of machine learning which is related to online training, some of the online tasks. When we say online, means that you are doing some real world activity. It could be driving an automated the some algorithm. It could be an application of self-driven cars like Teslas, and maybe the Google self-driven cars, which they are trying to train how to make a car maneuver different terrains, right, in a real world way, right? It could be playing some of the online games when you are not just playing against a real human, but you are playing against some algorithm which is trained, right? Which is not only pre-learned, pre-programmed, but it is learning online as well from your strategy or from thousands of those players who are playing against him or her, right? Now, uh, so such these are the broader applications of reinforcement learning, because it just does not confine itself from learning from a historical data set. It also learn from how different market participants in a real market, right, in the live trading hours, are taking trading positions, winding up, winding down, right? What directionality they are taking positions. It is reading into the other counter strategies as well, right? And to recalibrate, and then at the back end recalibrating its own trading strategies, so that it will stay at a competitive advantage from the market, right? So many of the contrarian strategies, the which are just playing against the market, some of the alpha generation strategies which are deployed by the hedge funds, right? They need this unique characteristic of the trading strategy which is different from the market. If the market is going one way, they call it rat race, right? They call it herd mentality. They say that, okay, if there's a herd mentality, obviously there are some areas to exploit by devising a contrarian approach or contrarian strategy, right? And that is where reinforcement learning, very uniquely placed itself. Now reinforcement learning just how it works is it's a area of deep learning. It's an area of deep learning where we are talking about deep neural networks, right? And reinforcement learning build those kind of algorithms which uh, very principally, if you talk about the design of those algorithms, they are principally like uh, a reward and penalty kind of a system. The algorithm, one, it is trained on the basic historical data and basic strategies. It will be then thrown out in the market. It will earn the reward if it performs well and generates certain profit. It will be penalized heavily if it enters into a loss making position, right? So the algorithm task is to keep accumulating rewards, and to maximize the reward. So how the algorithm is designed, that there's some optimization within the algorithm to maximize the rewards and minimize the penalties. It's just like playing a hockey game of hockey or a soccer, right? A player is being asked to play really out there, and he or she is not told any strategy. He or she is trained, on different strategies, and then asked to go and play any game with the focus of maximizing rewards and minimizing penalties, right? Now what does that do? That in itself create a unique strategy. Now you are not fixating or going by any assumption or any theory that this strategy is the profit making strategy in the market and this is not, right? You are leaving it to the market environment, to tell you to learn from the market environment and to redesign. Your focus is just to maximize the reward and minimize the penalty. The policy, the investment policy will be automatically learned. Some of the reward signal, right, will be automatically built into that particular strategy. A value function which you are trying to maximize will automatically formulate the formulation of the model, right? So that's where in this state space or the world space or the market environment or the trading environment or the investment environment, you learn the policy, right? You learn the policy is nothing but trading strategy. By examining different states of the market, different regimes of the market, and seeing what kind of action should have been taken, what is the probability distribution of the actions which have been taken which could yield to the maximum reward, right? Right. And create the maximum value. So the difference between reward and value over here is that it's eventually the profit, but reward is a short term profit. Reward is a short term profit, and value is a long term uh, long term accumulation of wealth. So sometimes when you are playing a mid term strategy or a long term strategy, you forgive short term rewards. It's not just about short term rewards, it's also about that this is the right position, I should keep holding this position for some time instead of booking a quick buck or quick profit out of it just to focus on reward. So it does the balancing act between the short term profits and the long term profits. So the how you maximize the value for your shareholders, how you create the value, right, over long term by following a particular strategy shows the stability of the strategy as well, right? That it is going to persistently, consistently be profitable across different market regimes, across different market scenarios. That's also the test here, right? So it's not just a player is thrown out and said that you have to play this county or you have to play this pre-match, right, and beat the enemy, but also he would be very calculative in learning the game from the enemy, from the opponent, and then preparing itself for a bigger game, right, like a champion series or maybe the finale, which is placed ahead of now. So by doing that, by also including some value function, how and we ensure that not only the algorithm cannot be programmed to be very greedy about the short term rewards. it need to sustain the rewards and make the rewards, accumulated rewards over time, so that the entire value or the wealth will be created out of that particular strategy. So that's how reinforcement learning works. And this form of besides the neural networks and the deep neural networks and the artificial neural networks and different architectures of that particular neural network, like long short term memory or gated recurrent unit, right? The reinforcement learning is a new thing which is really testing waters and trying to do the put more thirst and put more push to the adoption of machine learning techniques within the fold of the quantitative trading and the algorithmic trading. So that's the point here, right? So you could see that maybe there are many buy side and sell side firms. The buy side firms are generally maybe the asset managers or the various funds, investment funds, including hedge fund, and the sell side firms are mostly the investment banks or proprietary trading firms, right? So and the kind of activities they are doing, whether it is front office or middle office or back office, whether it's first line of defense, a second line of defense or third line of defense, the kind of activities they are doing, sometimes also motivate what is the objective out of the same algorithm which you build. Sometimes the focus of buy side is to manage the portfolio well or to do asset allocation well. However, the sell side is to find the price, to find an optimal price, or to find an optimal strategy, or to find an profit making strategy, right? Or to price the a very exotic OTC derivative very well, or a structured product very well, or to do hedging very well, right? So sell side focus is sometimes different from buy side focus, and maybe that's how the trading, the same algorithm would work differently for buy side or sell side. So that's the maybe another aspects of looking at it, right? uh, and generally collating few of the research papers which have been published in last 3 to 5 years. Uh, I just made this very small thing which talks about what areas of machine learning have been experimented well for the quantitative trading and algorithmic trading uh, problems or use cases. The first area is the deep learning, deep neural network, which a specific architecture of deep neural network is long short-term memory, which has been very well examined and proven its merit for time series prediction problems. And now these time series prediction problems are the time series is used to forecast the price, to based on maybe the traditional models like Arima, Serimax, your Gauge, Arch. All these models were time series models which were understanding the behavior of the stock market price or stock price or bond price or whatever price, commodity price or interest rate price, or interest rates or forex or whatever, right? So the time series uh, problem, which is a problem of sequential learning, because you have a sequential data, is handled through a deep learning neural network algorithm, which is specifically called long short term memory, right? Which has been exploited to solve the time series problem. And time series problem are required because they are the feeder model into the trading strategies. You need to understand the historical behavior and the of the price, and the dynamic or the historical behavior of the price, so as to do some time forecast over different spans, right? Then there's exotic option pricing. The neural networks are generally used because they are capable of solving the high dimensional problems. And when it comes to the exotic option pricing, like basket options or digital barriers or American options, so on and so forth, you don't have just a few set of variables or features or to examine. You have to gobble up, the algorithm has to gobble up a huge number of features, a huge number of variables, just to price the that a single structured product or exotic derivative or OTC derivative. It's not just there could be multiple underlyings, there could be multiple cross terms, interaction terms between these underlyings, right? So you can imagine that how many variables you have to include in your model. And if the neural network, the advantage neural network bring forth is that it is very good at handling high dimensionality. So the high dimensionality problems where there's a large feature space, large dimensionality involved, could be tackled through neural networks, specifically deep neural networks, very, very deep neural networks, right? The illiquid asset pricing, this is an area for market making activities and proprietary trading firms. So some of the boosted trees or boosted, classification and regression trees, as well as random forest, a technique which is proposed by machine learning, where you not just build one particular tree, but you create a forest of trees. You create a forest of trees, and then you do the voting across these trees to solve a particular problem. And the majoritarian vote, the the democracy of votes, the majoritarian votes, whether one should take position in a particular stock, whether we should take a long position or a short position, the majoritarian vote will then be declared as the final decision are coming out of a random forest. So similarly, trading strategies, which again have been examined using the boosted trees or the random forest, boosting and bagging. These are the areas of supervised learning and specifically used for classification problems, right? The difference between boosting and bagging, the bagging means the random forest, the boosting means the uh, 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 so boosting and bagging fall under the same kind of umbrella within machine learning. So supervised learning, then we say ensemble learning, where we combine multiple models, not just one model. And on the ensemble learning, the types of ensemble learning is either boosting or bagging. So boosting means building one model on top of another model sequentially. It's a sequential architecture or model building, where one tree says, I'm just talking about a basic algorithm like your cart decision tree, which is not very good at predicting. Its performance is boosted by building tree multiple trees sequentially on top of one another. Each tree will improve upon the previous tree which was having a large error, model error. So that is called boosting the performance of the algorithm. So sequential processing, right? Random forest is building huge number of trees, independent trees. These are not built over one on top of each other, but they are independent in their own way, right? And they are built on a bootstrap sample. That's why we call the bagging, bootstrap aggregation, and then aggregating, combining them to give the overall decision about the trading strategy. Then obviously some of the techniques like principal component analysis, independent component analysis, single value decomposition are used for dimensionality reduction wherever required, right? And obviously we have already talked through how some of the feeder models could be built to exploit the uh, alternative data sets, right? So that would include the if you are doing some image processing or video processing to which will enhance the view on the stock, on the trading information, right? Then you could use the convolutional neural networks. Similarly, when you are using any evaluating any news articles or Twitter, or maybe doing some sentiment indicators, building some sentiment indicators, you could use the natural language processing algorithm. When you want to summarize the articles, you could use the recurrent neural network. So on and so forth. Different types of algorithms in machine learning could be used there, right? So for your information, I have put some of these examples as well. And there are certain links where certain some of the good papers are further provided for further deep dive at your end, right? Just to get interested or just to learn the overall terrain or landscape of application of machine learning to quantitative finance, or specifically the quant trading and algorithmic trading, right? So and these are some of the additional material which provide some of the basic view on these algorithms, right? And this is what I explained about the reinforcement learning, right? Now maybe let's get into the other spell of this session, which is about giving you a tinge of flavor how the interview will happen. Now we would not, for the benefit of the audience, because you are coming from different backgrounds, we would not go into way too technical aspects, but we would try to cover the technical aspects in very simplified way, where Nitish would be acting as an interviewer and giving me all kind of goosebumps and maybe sweat right, playing on my nerves to just examine me for an interview, which is specifically for the trading strategies, or quantitative trading strategies, or algorithmic trading strategies, with respect of somebody who has this machine learning skill, right? What could be asked of him, what could be expected of him, how a candidate could be evaluated, right, for such a role, right? And this is we have designed this interview, the question and answers, in a way like it would target the mid career, right? Somebody having more than 7-8 years of experience, plus also it would give direction to those who are into the early stage of career, that what if they hone a particular skill, what how they position themselves for mid careers. So that's why we target mid careers. If you So this interview is all about hiring a mid career machine learning expert or a data scientist for a quantitative trading or a algorithmic trading rule family, right? Within an investment bank, within investment fund like hedge fund, within some boutique investment bank, or some broker dealer firm, or some proprietary trading firm, or any firm. So buy side, sell side, you know so we just try to maybe simulate it, right? For broader market, right? So maybe let me maybe then get started, and maybe Nitish, you can maybe take over from here.
Yeah, sure. So, yeah, I mean, as Sanjay has mentioned, I will be the interviewer and Sanjay will be the interviewee for like a mid-level position in a algo trading or a quant trading fund, for particularly for a machine learning expert, right? So, uh, yeah, Sanjay, so thanks for joining the interview. And so, then what we would like to start with is like by understanding from you. If you can share and elaborate on the ML use cases for algorithmic trading or quantitative trading problem sets.
Yeah, sure. So thanks for maybe having me here, and I would definitely, try to cover this answer by being more elaborative about some of the use cases which have been, tested well and experimented well using different algorithmic trading applications and different machine learning techniques involved to solve those use cases. So broadly we could see that maybe there are certain use cases which are very specific for the proprietary trading firms, and while there are certain other use cases which are specifically for agency trading, agency lending, agency business, right? So if you see a broader bank, we could build a machine learning algorithm or algorithmic trading application for prop trading firms, as well as for agency trading side of the business of that particular bank or investment bank or firm, right? So within prop trading firms we could talk about the strategies. First of all, the first use case is the strategy, how to device, how to design, how to develop, how to deploy those strategies. And these strategies could take different forms, but essentially different machine learning algorithms could be uh, deployed employed to devise a strategy, by which we mean that how, what kind of database, what kind of data cohort we are using to devise those strategies, whether it is only historical data, or it is some dynamic data, it is some augmented data, it is scenario based data. What kind of data we are using to devise those strategies, because a strategy is nothing but deduced out of the data, and we are talking about a data driven way of building a application. So uh, at that juncture we could use different machine learning models to process different kind of data sets, both traditional data sets or conventional data sets, as well as alternative data sets, to exhaustively cover as much information as we have, right? So then we would be able to devise the strategy based on the data driven approach, right? And that's the first point. And the second point is how to then design the strategy. The design of the strategy could be dictated by letting the machine, rather than fixating it, letting the machine to dynamically decide based on the different changing market conditions and regimes and environment, that whether it want to do the momentum based trading, volume based trading, or volatility based trading, or price based trading, or trend based trading, or sentiment based trading. So we leave it open, right? We leave it open, right? And then we will get the right kind of optimal strategy. So after devising, designing, deployment means that when to deploy that particular strategy to a particular market. So that is also one of the unique characteristic of machine learning algorithm, that it will quickly tell, it will quickly keep it in its background different kind of strategies for different, tailor made for different kind of market, suitable for different kind of market. And it will quickly sense the market based on certain sentiment indicators or certain indicators, and it will then play out one particular strategy from its shelf and employ it on the market, right? So this way we could build a strategy broadly, and the strategy could be uh, basically based on the fund own investment strategy, whether they want to do exploit the statistical arbitrage, volatility arbitrage, index arbitrage. They want to do the some automated way of scalping maybe the data and placing some positions there, right? The other aspect is the high frequency trading, which is when we could, so the here the application of the machine learning is to deploy the deep learning algorithm, and integrate it with big data technologies. So big data technologies will ensure that the data will come at a huge volume in a very fast way with huge velocity, right? And the deep learning algorithm will ensure that it can be processed by in a very fast way. It can process all the information and pass it through the neural network, different layers of the neural network, to finally give us a signal. A trading signal can then be used to take a trading decision, right? And we could build such kind of architecture models as well, which would be a combination of the pre-trade analysis models, and then post-trade execution models, right, to execute front to end in a very fast way. Then low latency trading is basically trading on the market microstructures. We could have examine, it's not just about trading on specific themes like arbitrage or strategy driven trading. It's not just about trading using the voluminous data and processing it very fast. It's about examining the long-term structure of the market and building some low latency models which could predict the market in long term, right? What would be the demand supply dynamics, or the bid offer spread, or maybe any kind of spread which will hold on to the market, and the term structure of the market. It would target the longer term structure of the market, and we could build such kind of models as well. So we could have, then we could have different kind of nuance strategies which would be very specific for episodic way, like some, if under a certain for short spell, some correlation is not noticed by the market, then we could and if our algorithm would be able to tell us that these are the covariance matrix and the correlation matrix between different instruments or different asset classes, we could quickly, or different markets or different micro markets, we could quickly do pair trading of different instruments as well, right? So all these could be devised using prop trading. Similarly for agency trading, when you're playing with your client funds or client money, which you have been mandated to deploy in the market, you could do volume weighted average price. So you, based on the volume, you could devise a strategy which would tell you what would be the volume weighted average price, and based on so here the assumption is that the volume is driving the price, right? And if there would be high volume in a particular instrument, you could, maybe the price will gain or surely gain. So similarly, such kind of agency lending strategies can be formed. Plus this area is also very interrupted by or disrupted by application to execution of orders, execution of bulk orders, execution of small orders, combining them together, make a sizable order, and then process it through the market at the right opportune time, right? So this order slicing, order analysis, processing, execution of the orders, right? Routing, order routing logic, right? So this also part of a business which is called execution services, which is on a business which is a sub business within investment banks. So this there the strategies, the execution strategies could be designed by the machine learning algorithm. So these are different areas where machine learning has already have had some footprints, and further the experimentation is going on to deploy majorly the deep neural networks, the reinforcement learning, the bagging and boosting algorithms to solve different problems coming from different the different areas of trading or investment within a particular large bank. So these I hope maybe I have answered that. Yeah.
Yeah, you have answered that very elaborately. Thanks for that. So, I mean, since you've explained about the used cases, right? So essentially now, like again, then I would next like to understand from you. I mean, if you can highlight the complexities involved in building a ML-based algo or a quant trading application. So if you can highlight the complexities.
Yeah, sure. So the algorithmic trading or the quant trading presents its own unique challenges and complexities and intricacies. Some of these are different from other areas of maybe the finance, right? And these are basically that the trading environment or the market is not directly observable. What I mean by directly observable means that we only notice it after an event happens in the market, but there's no direct way of inferring from the market what is going to happen, right? And the second aspect which is very important is, and which is put somebody who is a machine learning expert or a data scientist in a unique bright spot, is that most of the data around other firm strategy is not available. So these are proprietary information. You can only build your strategy in anticipation of how somebody else is going to place its strategy, but you never know, or you never get to know, because these are very proprietary confidential information. Everyone guard shield their trading strategies from rest others, because it's very designed to exploit the market, and people generally do not make it public, or this is not public information, right? So the use of simulation techniques, right? The use of how to simulate different trading trajectories, right, is key here. And we know from our traditional way of doing it that we do Monte Carlo simulation and some of the finite difference method and some of these quantitative ways of or computational ways of addressing this. But the problem with Monte Carlo is that Monte Carlo take a huge amount of processing power, and it will not be able to automatically adjust itself every time, right? Every time you have to do it from scratch, right? So a machine learning algorithm, if you know uh, uh, if trained to simulate different strategies or different trajectories, trading paths, or different investment profiles, right, or different profitability payoffs, could do that adaptively, in an adaptive fashion, in a dynamic fashion, on the real time. So the response time can be very hugely reduced. The computational resources can be saved by using machine learning here. The other aspect is where we have a lot of bias and noise in the trading information. By noise we mean that the generally the character of the trading data is very noisy. Not every information is a signal. It might just be a blip or just be a noise, right? It might just be a short-lived, very short-lived thing there, right? If that could be inbuilt into the model, it will create a, you know incorrect forecast or some model errors, right? Machine learning is very good at segregating signal from noise, right? Which is not generally expected out of uh, a traditional statistical or mathematical or computational model, quantitative model. Machine learning is very good at segregating the noise from signal, right? And there would be very subjective biases as well in the data, how it is being shared in the market. So some kind of sentiment indicators could also tell you that it is not just an opinion or a view of you, it is the general market opinion. So we could build such kind of thing to minimize the subjective bias and the noise which is characterized out of the trading data, right? The third thing is the time correlation complexity, and we know understand that the unique nature of the trading or investment data is that it is not time homogeneous, it is rather time heterogeneous. So you change the time span, right? You see that the distribution of the price or return will keep changing, right? So it is not time homogeneous. Some of the movements of the distribution, underlying data distribution, will keep changing from time to time, because the market regime is changing, market conditions are evolving, right? The economic setting are changing, right? So the micro markets are reacting differently, they are integrating differently, so it keeps changing, right? So there we can employ our, where there we can't just live with the fact that we can uh, device, design, and deploy and develop some data model purely based on some historical data, even some kind of augmented or simulated data. We need some online learning as well as the market evolve. So the reinforcement learning is an area which will address this complexity of the trading algorithm, which could maybe then be deployed to learn online as well, in the real time as well, and change its investment policy, recalibrate its strategy as the market changes to maximize the rewards and minimize the penalties. So that's where the challenges are, and that's where the machine learning present a unique set of solutions to address those challenges.
Very good. Quite nicely explained. And since you have a good idea about this application areas, right? So maybe I'll go into another question where I would like to ask that if you can define algorithmic trading design using ML-based reinforcement learning neural networks.
Yeah, sure. And thanks for asking this question. And maybe that's the moot point where the industry is trying to do a lot. And in coming years, it would have the potential of radically changing the way the trading happens, right? So maybe just conceptually intuitive design, the design of reinforcement learning algorithm, which is very nuanced model, very capable model of handling these application areas, is that you are as an agent. So the algorithm is an agent which is working in a observatory. The observatory involves so many things, and it's just basically the environment, trading environment, which is not directly observable, by the way, right? But the 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 trader or the trading agent is sitting in the middle, right, taking different signals by sitting in this observatory, and the observatory is so high dimensional. So you could have different states of the market, which is represented by ST, the different states of the market, different regime changes in the market, through which the agent, the reinforcement learning agent or your trading agent is learning how a regime change or a market environment change or market condition change, it would mean for your trading strategy. The second aspect is your normal data, right? Your direct information, right, which generally come in any traditional application as well, which is OH, LCV, open, high, low, close, volume, right? That kind of data which generally flows on a day to day or intraday basis, right, which tells you how the trading happens. That is typically the historical or empirical data which is directly observable, right? Rest everything is indirectly observable, right? The third thing is the trading time step, how frequently you are changing the time, right, in order to recalibrate your strategy. So it depends upon whether you are designing a long term strategy or a high frequency trading strategy. You can manipulate this time step from ticker to ticker, to weekly, to fortnightly, to monthly, to quarterly, to semi annually, to annually, to once in 3 years, to once in 5 years, whatever it may be, right? So that again depends upon how frequently your reinforcement learning agent is uh, taking observation very frequently, but how frequently it is recalibrating or readjusting the strategy, or rebalancing the strategy, or rebalancing the portfolio, right, based on the strategy, adopted strategy. Then there's a something called technical indicators. Obviously, most of these technical indicators come in the form of the moving averages. uh, then there's a well-known technical indicator which is based on moving average, which is very much used in advanced application, which is called moving average convergence divergence. Maybe how moving and averages converges or diverges, right? There's a relative strength index, there's a average directional index. So these are few to cite, which are worthy, that these are the quantitative the indicators which are taken from the quantitative chart reading. And this chart reading is again also happening in an automated fashion. So there would be a pre-feeder model which would read the charts, quantitative charts, and tell us, summarize that quantitative information into few indicators, which will then be built into your core algorithm, which would then use it for designing, devising, deploying, uh, developing, deploying, or maybe your strategy, which is automatically calibrated. Then last but not the least is the macroeconomic information. You could involve macroeconomic information as well, macroeconomic indicators as well, and these macroeconomic indicators uh, will come from a satellite macroeconomic model, or which will feed into all the macroeconomic data like your GDP, GVA, inflation, any monetary policy announcements, right? All this data will come from somewhere, and industrial production, CPI, WPI, all this data, and that can be built into your trading application. So this holistically cover the design of the trading application in terms of what kind of different dimensions of data which we would be exploiting. Plus it could be further built to include sentiment indicators, right, to include some news based indicators, to include some maybe to include some counter strategies, analysis of the counter strategies, right? So we could exhaustively include as many as we want, because we are talking about a reinforcement learning which is based on deep learning, which could process this high dimensional spatial data, as well as learn from online, if there would be any online thing to learn from, like a real trading happening in market. And the reinforcement learning agent is constantly taking inputs from that real trading activity and just trying to build some indicators or enhance some indicators which would be then playing a role in redevising or dynamically adjusting your strategies. Yeah.
Right. Right. So again, quite elaborative actually. So going to the next questions, if you can define technical indicators in ML DRL based algo trading application.
Yeah, sure. So some of the different indicators or different variables or different data streams which we are going to use for our algo trading platform or algo trading decision engine is clearly stated before. But in terms of what those indicators would be like there would be certain trend-based indicators. Obviously, the starting point would be that you would have when you are building a machine learning based algorithmic application, you would like to harness the alternative sources, and the alternative sources you would harness the social media data which a traditional model cannot. You will harness you will do some web scraping and go to the websites, the publicly available information, some of the SEBI, the capital regulator information, right? And you will do some web scraping and take some data from those sites where the forecasts company forecasts are given, or maybe some company latest regulatory news is given, some companies corporate governance standards compliance is given, right? So you will try to take that information as well by doing web scraping. And then you sometimes, while doing a very fundamental analysis, some kind of sensor or streaming data you could use built in, which would provide you the, suppose if you are analyzing the restaurant business, you could quickly take some sensor data, some satellite data to see what would be the total uh, you know total total people, customers who pass through the doors, right? In order to analyze that what kind of forecast they are making, are they supportive, are these supportive of the actual facts, how many customers are passing the doors through the window, or maybe in the peak cycles of the season, right? Whether that support provide a support to the revenue forecast, and based on that what multiple of that particular revenue we should be giving to these businesses which are basically the retail side of consumer side of businesses, right? So we could use that particular data. Obviously we would have all these typical the stock market price data, the open, high, low, close, volume, adjusted close, all of this. But we could then include some trend indicators, right, which would tell us about the directionality of the stock, right? Some directionality of the stock, and there are different trend indicators which are used for different asset classes or different instruments, right? So you could have different trend indicators as well. For commodity it would be different, for interest rate it would be different, for forex it would be different, for equity it would be different. Then you would have some momentum based indicators which will basically tell you that based on certain flows of money, right, whether there's a momentum, right, in one direction or not, right? So trend will tell you about the long term trend, obviously the moving average behavior. But momentum will tell you more about whether the that behavior is more supported by some kind of underlying momentum which is based on the flows of money into that particular stock or instrument, right? Then you could use the volume based indicators as well, which will be purely based on how much of the orders are placed for that particular type of instrument or that particular type of asset class, how much orders are placed, what is the supply, what is the demand over supply, right? So some of those kind of indicators, right? And then the main idea is nowadays that right, most of these nuanced unique strategies are not typically typically devised on the traditional indicators. Obviously they would form part of the overall trading algorithm, but mostly it is based on the volatility based charts, volatility indicators, right? Some of the stochastic volatility or diurnal volatility. Diurnal volatility means the volatility happening within the intraday, right? Diurnal volatility indicators, or some of short the volatility term structure, or the volatility smile or skew based indicators, right? So all these volatility indicators, which are different, which are like Bollinger bonds, or maybe some of these standard deviation, and some of these the analysis of variance, or maybe some of these indicators could be built into your trading strategies, to make it learn from as many technical indicators as possible.
Right, right. Okay. So again, it's a good answer. So going to the next question, actually, I mean, if you can define sentiment indicators in ML DRL based algo trading application.
Okay, so I'll be very quick and short, because the data here used for sentiment indicators is processed by the natural language processing algorithms, which are different set of techniques within machine learning,
Hmm.
which are good at processing the textual data or speech data, or news articles and all of that. But the main data for trading application would be the news articles from the economic dailies or business dailies or investment journals, right? The Twitter data, obviously, where the on specific tweet handles, the different traders or trading firms, just express their opinion. The forecast, analyst forecast, which are for top, say, any of the top 50 or top 100 firms of constituting a particular index, which is reflective of the market. They express their forecast, right? So the different analysts comments about the forecast, that the forecast is they see forecast with a discount, or they see forecast as correctly as a correct version of the future potential of that particular firm, or the future price of that particular firm, or the future market capitalization of that particular firm. So such kind of opinions are expressed, plus different opinions like bullish, bearish, neutral stance. These are different stance are expressed by the market from different corners of the market, be it your retail side, retail investors, institutional investors, some of the market makers. They express different opinions on the market. Some of the market analysts or pundits, they invest, some of the broker dealer firms, they express different opinions of the market. Now the problem is, some of the data is not just text. They are just when you go on a tweet, they are just expressions, symbols, right? So you have to employ NLP, natural language processing algorithms. Sorry, you have to employ natural language processing algorithms to harness that particular data. Whatever comes through on Twitter, Facebook, LinkedIn, any other platform, news articles, journals, right? So that is where we could build strong sentiment indicators, which would then be embedded into our trading uh, platform and trading strategies and trading decision making.
Right.
Yeah.
Okay. Maybe going to the next question then, that we would like to understand is, if you can call out disadvantages of deep learning, that is deep neural networks.
Yeah, so that's a good question, because when we are trying to build up a case for use of deep learning algorithm, deep neural network algorithm for different application, and especially for quantitative trading or algorithmic trading applications, we should know well in advance that what are the doom side or the downside of, or the disadvantages which the industry is grappling with and trying. There's different sort of research, ML researchers, who are trying to make these models more explainable, more interpretable, more comprehensible. But the first is that these are black box models, right? These are black box
Right.
models. They don't have a set parameterization which could be clearly explained that, oh, this particular indicator plays this much role in your trading strategy, or in your profit making strategy, or in your investment strategy, right? So that's not a clear mapping, right? So there's a lack of estimation transparency there, right? These models tends to overfit the data, so they tend to over predict and overfit the data. They try to learn as much as they can, and sometimes they turn greedy, and their greediness could, if not controlled well by manipulating some of the hyperparameters of the model, if not controlled well, so they learn everything. They end up learning some of the non signals as well, right? So that could distort your strategy. So we should be aware that if the overfit, the problem of overfitness need to be addressed appropriately for neural networks, deep neural networks. The another thing is that the design of the neural networks is an area which is not standardized. There's no thumb rule where you could say that you need to have these many layers, these many layers in the neural network to make it really deep, and these many neurons within each layer. So the overall architecture and design of the neural network is experimental, right? Is experimental. So the same algorithm could be built using 10 layers in the neural network, or 20 layers on the neural network, or even 5 layers in the neural network. 100 maybe of neurons in each of the layer, maybe 200 of neurons in each of the layer, maybe even 50 neurons in each of the layer. So that is a bit of experimental, which somebody who is a machine learning researcher need to do a bit of experimentation in right kind of algorithmic design for the problem set, right? So that's again an area which would require additional effort, additional maybe thought process there, and it
Right.
generally takes a lot of time, which is not comparable to how much time Monte Carlo takes, but it also is trained on GPU power. But unless you do a parallelized computing or a distributed computing, right, you would have a lot of time in training these algorithms, right? So these are some of the disadvantages to call out for DNN.
Wonderful.
Yeah.
All right. So, I mean, yeah. So I mean, I think with that we come to the end of the demo interview session. Thanks, Sanjay. Right. So, I mean, we'll go into the Q&A now. And before we go into the Q&A, maybe like again, just allow me to give a brief intro about ourselves and like what we have been doing over the last 1.5 decades, right? So, and then we'll go into the Q&A. Right. So very quickly, as you know, I represent Indian Institute of Quantitative Finance, and we have been a pioneer in the field of quant education and training in India, where we have been an institution dedicated to the field of quantitative finance, financial engineering, risk management, quantitative algo trading, and artificial intelligence and machine learning. We were founded by pioneers in India and top experts from the field of financial risk management, financial engineering, and investment banking. And we have focused on education. I mean, focused on promoting education and training in the field of, as I said, financial engineering and quantitative finance, algo trading, and several other areas of modern finance for more than a decade, right? And uh, we have dedicated courses actually to prepare people who want to enter into different areas of advanced analytical areas of finance. I mean, be it machine learning or be it quant finance, right? So depending on what kind of advanced analytical areas of finance you want to get into, or if you're already there, I mean, how if you want to go deeper and make use of this knowledge to go more deeper into your deeper into the profiles, right? So we have certificate courses which are very deep and which makes you job ready for different aspects of the quant industry, right? So to start with, I would like to mention the certificate program in machine learning for finance. Since today's webinar is about like machine learning field, right? So this is like a very specialized dedicated course which is designed to teach machine learning and data science in context of applications in finance, right? So I mean, this is like an 8 months course, and all these courses that I'll be talking about, these are all weekend live interactive lecture based courses which helps you, as I said, build a background and directly enter into the desks, so which makes you job ready, right? So now, I mean, this machine learning for finance course, the difference between this course and multitude of other courses that are there in the I mean, offered by so many other institutes is like, I mean, machine learning and data science is now offered by thousands of other people, right? But again, not many, I mean, in fact, there are not many courses which of specializes in finance, right? So teaching machine learning applications in finance. So this is like a course which teaches machine learning and data science in context of applications in finance. And I mean, in terms of the case studies, in terms of the white papers, in terms of the capstone project assignments, everything will be from finance, fintech, credit analysis, derivative valuation and pricing, risk management, algorithmic trading, so on and so forth, right? And then again, if somebody wants to enter into the industry as, or like again become a quant analyst or go into risk management, we have a course called certificate program in quantitative finance and risk management, a 6 months course which comprehensively deep dives into both theory and practical modeling for derivative valuation and risk management. Then we have a course of certificate program in financial engineering, again for somebody who wants to become a quant in the industry. I mean, join an international bank or big four consulting firms or other organizations in the quant and risk analytics team. So in a very comprehensive course which deep dive into both theory and practical mathematical modeling for derivative valuation and risk management. And if somebody wants to specialize in quantitative or algorithmic trading, so we have a course on algorithmic trading as well. It's called a postgraduate program in algorithmic trading, another 8 months course, which teaches all aspects of algo trading using technical analysis, machine learning based models, quant models, and all other kinds of models, right? Then there's a shorter version of the algorithmic trading course for people who don't want to go into too much of quant trading. I mean, it's a 4 months course that teaches end-to-end all aspects of algo trading using technical analysis, right? So these are all part-time weekend courses. The machine learning course module, I'm not deep diving into it. I mean, anybody interested, we can have a detailed discussion in terms of that. I'm not deep diving currently. So essentially, if somebody is learning about machine learning, then the potential career track are like, again, the WML program caters to building practitioner level skills to broadly cater to any and all machine learning and data science driven role families, with a few real examples from the job market given below. Data scientist for financial accounting decision systems, machine learning model designer for financial forecasting and predictive models, forensic audit data scientist, fraud analytics machine learning expert, risk finance compliance machine learning data engineer, or you can go into machine learning modeler for quantitative finance models, or you can go into machine learning driven algorithmic trading, or you can become a machine learning model validation expert, right? So from our side, I mean, whichever course you do, I mean, we handhold you and prepare you and make you ready for the industry, and then we connect you to the industry. So the support system start not only during the course, but even before the course, where we discuss and guide you, give you a career counseling, understand your background, and then suggest what would be the right course basis your background, basis your aspirations and interests, right? So we start by doing a detailed career counseling before you join our course, and then only we suggest you the course. During the course, you would have career mentorship by industry experts. The faculties in all the courses are leaders from the industry, and then some of the academic researchers who are like leaders from their research field. But primarily, these are all industry leaders, right? So, I mean, you can ask them questions, and then you can, of course, pick up their my brains, right? So then there is a dedicated placement support team at the end of the course. If you are looking for job support, We do have a dedicated placement support team which works with you, do your profiling, and then send your resume to relevant companies, particularly in the teams where you have the maximum chance of getting interview calls from. And in any case, with almost 15 years of of our existence, the industry network is pretty strong. We ourselves are from the quant industry. The faculties are leaders from the industry. A lot of the students, they are leaders in different parts of the industry. They've gone on to become, gone on to been leaders in different fields. And then there is a team which constantly connects with the industry, right? So it's the industry connection is pretty strong. And as I was mentioning, while supporting you in the placement process, we do your resume building and profile improvement as well. So it's a holistic approach for teaching, counseling, and then placing you in the right companies. Right. So, I'm not elaborating on this. It's been a long journey, and lot of professionals and students have used our courses to make fantastic quant and algorithmic trading and machine learning related careers, risk management related careers. A lot of them have been kind enough to share their experience, and some of them has been shared here. But again, this is not to brag about like this. It's like about to showcase how actually you can use these courses to improve your positions, or you can get into this kind of quant or risk management or machine learning related positions, right? So you can go to our website and see them. Target companies, of course, it would be like hedge funds like Renaissance Technologies, DSO, Citadel, Millennium Partners, investment banks like Goldman Sachs, commercial banks, stock exchanges, consulting firms like EY, Deloitte, PwC, and IT companies like Accenture, Cognizant, TCS, etc. Right? So, the types of profile anyway. We have discussed that. Essentially, there's a long association with a lot of clients and in financial institutions over the years, and this is just a small list, not like again, and it's just an indicative list. And similarly, we have tried to, in our endeavor to promote this field, we have been working with educational institutes as well, like IIT Bombay, BITS, Pilani, and ET, conducting workshops, promoting things in quant finance area, right? So that's also been like what we have been doing over the last 1.5 decades. So in case anybody gets interested, they can contact us in our website, iiqf.org. You can call us on this number mentioned, or you can email to us. We'd be happy to discuss. Right. So now, like again, quickly going into the questions, and we will take maybe another 10 minutes to answer the questions that we have. Sanjay, if you're ready, we'll go to the questions.
Yeah, sure.
Right. So we have a first question from Harsa, and Harsa says that she is from pre-sales, and she says that I would like to know more about pre-sales opportunities in ML. That's a unique question. So would you like to take that?
Maybe I was speaking on mute, sorry. Yeah, so thanks, Harsha, for asking this question. And with respect to pre-sales, the Indian market specifically is booming a lot, because there are a lot of product companies as well as the fintech companies, and many consulting firms which are creating their own ML based products and services, right, which are there already. Right, to name a few, I'll take few examples like FIS Global. Right now, FIS Global has already set up its Asia biggest existence in India, besides Singapore, to build on those particular applications of machine learning, which is used for derivative pricing. Now, in pre-sales and sales role family, they are hiring a lot every then and now, right? And where it has been seen that recently there's a upsurge in such kind of jobs. And it's not limited to just one firm like Quantify, if you have heard of, Numerics, uh, Murex. All these are trading platforms, as well as few other consulting firms like KPMG, Deloitte, EY, or PwC, the top-notch Big Four consulting firms. They also hire into the same space, including Protiviti, not only Big Four, right? But the idea here is that somebody should understand the machine learning use cases as very well in a pre-sales. Somebody should understand the product design very well. Somebody should be able to talk in technical terms to their technical teams, the ML research teams or ML engineering teams, to deliver a solution or to adapt that particular solution to client requirements, and that form the part of the pitch book. And somebody who already is well versed and familiar with how to how machine learning is being used for different application areas, how the design framework works, how maybe what additional resourcing or requirement goes into building that particular product expertise or solution expertise. What challenges are there in order to adapt to a particular client requirement, including some of the other requirements on data privacy like GDPR or confidential data confidentiality, or how we explain the output to model or model output to the regulators. All of these aspects become more important and will place you in a unique spot where you could be seen as a mid-career professional or a nuanced professional who is holistically knowing the areas of machine learning applications to various financial problems. And obviously, these product companies have derived most of their revenue and profitability from these big banks. So there's no doubt that they obviously need somebody who can connect machine learning closely with finance, right? And there's many such firms already, right? Including what I heard recently is that the SaaS are maybe even the MATLAB. These product companies are also hiring into such roles, which are role families including pre-sales, sales, business analysts, right? Which cater to the same thing, and if even if they are not doers themselves, they are well knowers, right? Who can clearly articulate the solution or the service design or the maybe infrastructure design or the product design to their clients while pitching for such offerings, right? So that's very much there. Yeah. Yeah, that we can clearly see, and that's the first role which is scaling up a lot in India.
Absolutely. Absolutely. So next question is from Yes, and he has asked, oh, sorry, before going to that, Harsha, I think I hope that answers your question. If you have any follow-up question, all right, sure, thanks, thanks. Now, like next question is from Yes, and he has asked like he's a fresh grad working as a software engineer who is keen about high frequency trading. And as a heads up, will IIQF be relevant for people wanting to become quants for top HFT firms like Optiverse, Citadel, Graviton Research, etc.?
This is question from whom? May I get the name
Yes,
again?
yes,
Yash.
yes.
Yeah. So yes, Yash. So I would try to answer it more generically first, and then specifically then. So generically, for those all of those who are coming from IT background or IT role families, or even fresh graduates, with your bachelor's in computer sciences, right? This is the way forward, right? There's no doubt about it, right? How this is the way forward, that and IT is becoming IT generic IT is becoming very commoditized, right? Although we are known for IT capabilities, but it is becoming more commoditized. The only way to ensure a, a career which will pay you, reward you well in long term, is to quickly adopt an area which links to the IT. And machine learning is such an area which is not just a rubber stamp of statisticians, mathematicians, or maybe somebody who has had long career in finance, but also an area which requires a lot of algorithmic fine tuning, algorithmic development, coding skills, programming skills, right? So it's a very good spot for somebody who already has a decent or reasonable understanding of programming languages, computer science skills, and want to come into a new area called machine learning. Obviously there's a road ahead for those people, because they need to understand domain. By domain I mean finance domain, right, which we would be catering to, as well as the machine learning domain, right? But that's the unique USP of this course, that it combines, not just it just not provide you a machine learning. There are many courses, I would clearly say that there are many courses which are good courses on machine learning, but the unique feature of this course is it combines machine learning application in a very use case specific way to finance, and broadly every area of finance: risk management, quantitative finance, computational finance, algorithmic trading, portfolio optimization, investment management, even your financial forecasting areas, accounting areas, fraud analytics, everything, right? So we try to maybe cater to everything, try to discuss use cases which are specifically for these areas, right? And even some of the generic use cases, even if tomorrow you decide to work with Google, say suppose hypothetically, and not that these big firms are not trying to get the banking license. The like of Google, Amazon, they are also trying to get the banking license and get into the fintech industry, right? But the point is this, that even if you generalize it, the machine learning across e-commerce, across pharmaceuticals, across other areas like biotechnology or aerospace or whatever area you would like to go, right? Some of the essential skills or would be enhanced, which would be built up to the level of the mid career level skills, or the those skills which would place you well for every industry. And because machine learning is very agnostic, the good thing about machine learning is once learned for a specific domain, and the financial domain is one of the most challenging and most rigorous and most difficult domain to understand. But once built for that, you could be easily cross pollinate such understanding if you would like to try out any other industry later on, because machine learning data scientist role family are not stereotypical, they are not tied to one domain or the other, right? So we would be
Correct.
training you for a complex domain, but given the machine learning skills, you could then broadify yourself in your future careers, right, to be placed for other industries as well.
Right. Absolutely. Okay. So, next question is from Saurav, and he has asked, are all RL now cloud-based for algo trading?
So that's a good question, and indeed a very relevant question, because that talks about the overall architecture of these algos, ML based algos, which are deployed on front to back architecture, right? So we should not tie it back to machine learning, right? This is about, that's why we have a specific module in our course, right, which talks about the architectural principles, front to back architecture, front to back design architecture of machine learning, which include the big data technologies at the uh, upstream level, right, where you would be getting understanding or maybe getting familiarized with the big data technologies which would be used to bring in huge large amount of data, right, in huge variety at huge great speed, right, into your data cohorts or data lakes, right? And those big data technologies like Scala, Spark, Hadoop, or there are different. technologies would be part of the overall architecture. Then on deployment side, you would have this cloud-based architecture where you would be deploying your algorithm not on a physical infrastructure but rather on a virtualized infrastructure, right? Because that virtualized infrastructure is required because machine learning scale up and scale down from different time to different time. The algorithm might take huge space or huge processing power, so you need not to be fixated in a physical infrastructure kind of constraint. You got to virtualize it. So yeah, obviously, so cloud based algorithm is the natural way of deploying ml uh, you know uh, ML algorithm or ML models, and that's the way forward. And these are this is the very de facto way of deploying a ML based algorithm. So that's true. And we would also be having a module which would cover how these models are deployed on cloud, and what kind of infrastructure or infrastructure as a service would be required for somebody who is looking to strategically deploy these system in a production like environment.
Absolutely. Absolutely. I hope that answers your question, Saurabh. Now, a couple of follow-up questions from Yes and Sanjay. We have already exceeded half an hour of our time. So the next few questions we will take within the next 10 minutes. So, I'll request you to be a little brief, right? So, next question is a follow-up question from Yes. I'm taking it because it's relevant. So he is like mentioned. The question is, are dark pools observed in Indian markets? And second question is, I've heard quant roles in HFT firms are more or less reserved for IIT grads since they have proved their aptitude. How does one go about proving capabilities in this space? Also, what kind of salary can be commanded in this space? So two questions.
Okay, so just quickly, Yash, to answer your first question, dark pools, yes, dark pools are observed in the market, right? Indian market specifically, and with a lot of these, huge wealthy clients deploying the money into the Indian markets, there's a possibility of dark pool, but it's not as general as the developed market. But because since we are emerging market, so it's not that as rampant as a developed market, but there are dark pools, which have been examined by many in the Indian market as well. The second question is that is this an area which is completely reserved for someone with the tag bearers? No, no, this is not the area. Uh, so with me and many of my colleagues, not from IIT, right? We are still working in this area, right? And the broader thing is that even IITians sometimes struggle in this area, right? It's not about just a degree or a, Ivy League label which would ensure a successful career in this area or entrance in this area. The area we are examining a new century where there's a dearth of resources, data scientists, machine learning expert, ML driven data ML engineers. There's a dearth, and it's a huge uh, paucity of resources, right? The only thing is the hiring pattern has also changed. Nobody look at see your resume and try to find the IIT IIMs or maybe those kind of keywords there. People look at your resume and try to find whether you have done something in machine learning or not. If you corroborate that, if you have a GitHub profile, if you have a project, if you have an expertise on any algorithm, if you have examined the use case of a particular algorithm, right, that will definitely be a v- you know go to situation for anyone to consider you seriously without stereotypically too much linking it to your previous education or whether it's coming from a premier institute or not, because those premier institute themselves have not so far been able to come out with a any specifically designed course on machine learning. That's where these certification courses, like the one which we are talking about here, is trying to bridge a gap between the academia not catching up with the trends and industry trying to hire as many resources, they are placing more demand on such resources where they could not see where the supply would be coming from, right?
True. True. All right. So I hope that answers your question. Question, yes, or questions rather. Yes. I mean, yeah. Just to add, actually, as Sanjay rightly mentioned, I mean, uh, yeah, you may hear that, like, again, ITNs or like even grads are more preferred, but again, that's not the case. I mean, if you build the right skill sets, if you build your right credentials, then this is like an emerging field which is still dynamic, and there are a lot of paucity of resources. So once you get trained, yeah, I mean, if properly, then there is a lot of opportunities which actually can be held. I mean, it doesn't require you to be an IITN or an IIM guy, right? So coming to the next question is like from Deepak, and he mentions that how the primary data is dealt with using ML. And a follow-up question: how difficult is it to build a ML RL application by an individual for algo trading?
Yeah, so Deepak, that's also a good question, very pointed question. Thanks for asking. So the data, and the capability of ML algorithm in order to harness the potential in data and to build the data in a data-driven way, they build the models in a data-driven way. So is the defining differentiating characteristic which differentiate it from the traditional mathematical and statistical models, right? So the buck starts there, right? And where it stops is that what kind of algorithm you are used to handle the primary data. So as I covered that, maybe many of the NLP, natural language processing algorithm, are used to process the text data, the speech data, maybe the voice data, the IoT data, right? As well as the Twitter data, social networking data, the analyst opinion data, the news articles data, right? So there we use the NLP algorithms, right? And then for image and video processing, like video captioning or image processing, right, we use the convolutional neural network. So these are two different uh, algorithms, but broadly, in order to harness the alternative data sources, these are broadly widely used, specifically when you're trying to build a ML algorithm. The second aspect is whether a normal Tom, Dick, Harry can build a RNN, recurrent neural network, uh, provided that you have skills, provided that you have knowledge, because this is not just plain vanilla stuff. I'm just making aware everyone. This would require you to know, understand the mathematics of algorithm, the statistics of algorithm, the probability of algorithm, the programming of algorithm, right? And the deployment and the surrounding ecosystem, how it is deployed into a strategic architecture, all that understanding, right? Given that you would build those kind of understanding, yes, then you can start experimenting. And for rest of life, it is then up to you how you could examine different applications, different data sets. And many of the data sets, which is shared by Kaggle competition sites, or there are many data sets which are already available on GitHub, are readily available for you to somebody to experiment, right? So data is not the issue,
Right.
right? How you go about solutionizing from data is the biggest thing which one need to figure out. But with structural knowledge, you can't just go all loud and just, if you know Python, you can't just start working with data, something. Yeah, you need to understand the algorithms well and the models well and the area well.
Right. And next part of its question is how difficult is it to build an ML RL application by an individual for algo trading?
It's not difficult. Yeah, it's not difficult. The only thing is that to an extent it would require some part of data which is not readily available, right? You ought to be working in a firm where you would have direct access to the trading data, right? The trading feeds which are coming from trading desk, right? To build a online based learning, right? Your Then only your algorithm will learn how the trading is happening in the online environment, right? But it's not difficult. It's just a case of whether you have access to data or not. right? The public data is already available, but some of the other form of alternative data, or some of the form of online data would require you to have access to the right data sources, and you should be part of those maybe areas, or maybe those application areas, right? But in general, just to demonstrate, we could simulate the data, right? So that is again also not the problem. We could augment or simulate the data, and uh, the model could be created, which then, if given the real data, would be then tested, right? So that's not the constraint as such.
Correct. Yeah, I hope that answers your question. Okay, so final two questions, quickly speaking. One is like from Rahul, or Rahul actually has a set of questions, which are, I mean, one follows the other. So the first question from Rahul is that he asked, why use machine learning rather than technical indicator? Follow-up question is how the data output of ML-based indicator would be different as to technical indicator. And he mentions that I currently code strategies. Recently, I have started with hedging-based strategies, and that is dynamic in nature. What course would you suggest right now? I am looking forward with CAPFE. All right, last question maybe. I mean, you can answer all of them, and last question maybe I'll add up.
So the first two question, maybe I'll try to answer one by one. So the first question was whether how ML is different from pure quant trading, application. Not quant trading, but quantitative indicator based trading algorithm based algorithm application. Now it's very different. The ML algorithm is just using, you know, the quantitative indicators, or the quant charts, or the Bollinger charts, and whatever the momentum based indicators, technical indicators, as just one of the subset, right? But in order to design a particular strategy, would you say that it is only based on technical indicators? No, it's not. It would require a lot of other indicators as well, like many of the sentiment indicators, even some of the fundamental indicators, some of the systematic indicators, some of the macroeconomic variables, right? So in order to, when you try including all of that, the problem becomes so high dimensional that it cannot be handled by a traditional algorithm. So that's why you need machine learning algorithm, because which is very good at handling high dimensionality problems, right? So that's the first. The second thing is that how the output would differentiate between ML and a typical technical indicator based algorithm. The output will vary differently. The markets are not always driven by technical charts. Those traders who follow technical charts, they generally stay away from the market when technical charts would not meaningfully lead to a winning strategy, right? There would be markets when something else could work. So you when in areas where you are talking about how an investment bank or how a big firm will design its strategy, would not just be based on technical indicators. So the output from technical indicators would be what technical charts could tell, right? But technical charts could be very disguised, or very they, first of all, they would not be able to tell you specifically why two trades, right, similar, having similar fundamentals, would have different technicals, right? They're trading in same market, same volumes of everything. So you would not be able to differentiate more, right? So there are many constraints of doing only technical chart based trading, right? Which, if a strategy is devised where the technical indicators form a subset of the overall set of variables which are considered, would work, because it would then take everything into account, including the technical indicators. So that's where the machine learning models give a different set of output, which is covering as much data from different dimension as possible, not just fixating it to only technical or fundamental analysis, right, or macroeconomic analysis, just to take a position in the market. Yeah.
True. Absolutely. And just to answer briefly about your third question, Rahul, which is about which course would be right for you. I mean, this is something we would be happy to discuss in detail one-on-one, but briefly mentioning, so essentially, since you already code strategies and all, right? So, and I mean, it's wonderful to know that actually you already have that coding background, right? So that's very useful. I mean, in this field, when you talk about quantitative trading, right? So you can choose between either of the courses. I mean, to become a quant trader, there are two aspects. One is the trading side, the coding knowledge, the trading market knowledge, and all that, right? So which actually to some extent you already have. Another is the quant domain knowledge, right? So if you are looking for the financial engineering course, it's absolutely the right course because it teaches the quant domain side in deep, right? So that domain side will help you in, like, again, becoming a quant trader. I mean, as I said, quant trader, as the name itself suggests, it requires knowledge about two aspects: the quant domain knowledge and the trading knowledge, right? So the coding and all this stuff you are already doing. Now if you add the quant knowledge, then this is like right combination. On the other hand, you may also look at the machine learning for finance course, but again, that is not specific to only the trading aspect, as we were explaining a while back. The machine learning course is a course which teaches different applications of machine learning in finance, different areas, right? So including algorithmic trading, derivative valuation and pricing, risk management, your credit analysis, fintech, and all these areas, right? I mean, so that's like something also can be looked at, because machine learning also is a hot area in finance. I mean, as with every other field. But specifically, if you're looking to become a quant trader, then I mean, it mostly it would be the FE course. But yeah, if you want to if you want to specialize in the machine learning areas of finance, then it would be the CPMLF course. So either of them, depending on your interest, inclination, actually, or not, right? And sorry, Rahul. So I hope that answers all your questions, Rahul. Very quickly, the last question we would like to take up is, in RL, you mentioned a reward for a correct decision while training a dog. So we give it a treat for every correct obedience. But how do we know how a reward is awarded to an algorithm? I mean, how do we know what the RL agent likes as a reward?
That's a good question, and that's about the insider of uh, the RL, the reinforcement learning. So reward is a function. It's not a typical freebie. It's not something like a physical thing which you are giving. It's a function, right? You define a function, and then you code your algorithm so that algorithm will optimize that function maxima, and the optimization would be the maximization of reward, achieving the maxima of that particular reward, right? So a reward could be bounded as well, a reward could be unbounded as well. That's how, maybe that's just a manipulation of the function, how you define your function, right? But over time it might be, is it different from the physical world, the real world? No, it is not. You see a trader, when he trades, he get bonuses or incentives, right? More than his salary, take home salary or whatever. He A trader is known for, getting huge bonuses. So the bonus is reward. So we could even emulate w- a bonus system for a trader, a similar system for rewarding the trading application, right? So it could be emulated very easily, right? But essentially it's a mathematical function which need to have some mathematical form, which will based upon what kind of profits are generated, whether that profit meets the ROE requirement or return on capital requirement or of the firm, right? It would give a reward, right? It would give a fraction of that particular thing to the algorithm, so that the algorithm would know that it has been rewarded by taking such decision. And over time, the action space of the algorithm, the RNN action space, right, would be like, algorithm will get to know intelligently that, okay, after taking this action, right, I was rewarded this, and after taking that action I was rewarded this. So what algorithm is doing, algorithm is comparing action by action out of so many action, a huge distribution of actions, right? That which action was more rewarding under what circumstances. right? So that's how algorithm will keep optimizing and learning, and once it learned, and then it would take the right action under the given scenario.
Absolutely. So I think with that, we have come to the end of the session. Is like we have answered all the questions. There are two, three more questions, but those are of repetitive nature, which you have already addressed, right? So, and in any case, we have extended a lot of time. But idea about this sessions is to disseminate knowledge, right? It's not like only time foundation. So, idea is to help people understanding about the field in general, and again the application areas, right? So we try to answer all questions and queries as much as possible. I mean, sometimes if it takes a little extra time, so be it. I mean, it should be useful to everyone, right? So I hope you all have enjoyed the session, and again got like good amount of learning. I mean, I hope the session was useful to all of you, right? So with that, first of all, thanks so much, Sanjay, for your patience in answering all the questions for a wonderful session. And as I said, your patience in answering all the questions, we have extended about like an hour's time. So it's like a huge amount of time. Thanks so much. And thanks to all of you for taking your time out once again on a Sunday and joining us. It shows your interest. And so before we sign off, keep following us in our various social media pages, our website, because we keep conducting this kind of important sessions from different parts of the industry in quant, uh, uh, machine learning, algorithmic trading, and all relevant areas of advanced analytical areas of finance, right? So keep track of us in our website, in our social media pages, and we will also keep you intimated by emails about our next sessions. So see you in the next webinars. Whenever, I mean, please feel free to join all our future webinars. See you there. Thanks once again.
Thanks all. Thanks for such being such nice audience. Thanks all. Yeah.
Right. So yeah, Harsha would like, yes, Harsha has mentioned, would like to connect into this, connected with my question. Thanks for your time and arranging this wonderful lesson. Thanks, Harsha. Yeah, please feel free. You can connect with us on this number, or maybe I will mention my personal official number as well. Yes, so this is my direct number, Harsha. I mean, please feel free to connect with me on this number. I'll be happy to discuss and answer all your questions. Right. So, with that, we would like to conclude the session for the day. Have a great day, everyone. Thanks for joining. See you again in the next webinar. Thank you.